Ever wondered why your Naira seems to be on a perpetual diet, losing weight against the global currency? I know you do. For quite some long time, decades or even multiple of decades, Naira has been losing value and there is nothing good coming out of that. Let's talk about this problem today. First of all, let's understand what devaluation means. Currency devaluation is when a country intentionally lowers the value of its currency relative to others. Think of it as putting your currency on a clearance sale. It is a monetary policy tool used by countries with a fixed exchange rate or semi-fixed exchange rate. Mind you, the word intentional doesn't mean willingly or happily doing so. They do that for a reason or some reasons. The reason and many other things related to this are going to be discussed comprehensively in this video. Please do well to like this video to appreciate our efforts, and please subscribe or follow if you haven't so far. Thank you. Let's take a step further. Currency devaluation, in other words, is just the deliberate reduction in currency value. Now that we know what currency devaluation is, let's get to know the factors that cause it, because you might be wondering what might be the reason for a government to lower the value of its currency. Why would they do that? They do that actually for some reasons which might be, maybe they might be under forced to do so, or some other reasons. Let's just dive into the video, and I believe you are going to understand everything regarding currency devaluation, regarding Naira's depreciation before the end of this video, or towards the end of this video. So we are going to discuss a few of the major causes. Well, the first we are going to discuss is interest rates. And like we all know, interest rate is the price paid for obtaining or price received for providing money or goods in a credit transaction, calculated as a fraction of the amount or value of what was borrowed. This is something I find from a dictionary. Let me say it in a way that will be relatable, in a way that everybody can comprehend. Interest rate is the cost of borrowing money or the reward for saving it, usually shown as a percentage. Let me give you an example. If you borrow money from a bank with a 10% interest rate, you'll pay back the original amount plus 10% interest rate, or let's say plus 10% extra, which is the interest rate of that transaction. So this interest rate is one of the factors that causes currency devaluation. How? Let's explain further. There are two factors under this interest rate itself. There are high interest rates. High interest rates usually attract foreign investors seeking better returns, increasing demand for the currency, and anything that is under demand definitely goes up in value. And conversely, lower interest rate can lead to a currency devaluation, because devaluation or depreciation, anything, because nobody wants demand such currency because it has very, very low interest rate. The second factor is inflation rates. Inflation is when price rises rapidly, price of goods or price of commodity rises rapidly. A currency loses its buying power, making it less valuable, both locally and internationally. So due to inflation, value of a currency can go both up or down. Low and stable inflation is generally good for a currency value, while high inflation reduces a currency purchasing power, leading to depreciation. And another reason is economic growth and stability. A strong growing economy boosts investor confidence and increases demand for the currency, while recession or political instability can cause investors to pull out, lowering the currency's value. So definitely, any currency whose government is very unstable and there is no growth in the economy of their country, definitely the price of the value of that currency, I just finished explaining it, is going to be going down in value. So the fourth of the factors of the causes of currency devaluation is foreign exchange reserves. Countries with large foreign exchange reserves can stabilize or influence their currency value, while low reserves can lead to currency volatility or devaluation. That is why almost all countries that are capable tried as much as they can to maintain or to hold high reserves in their own countries. Then the next is public debt. High level of national debt can discourage foreign investors and lead to fears of default, reducing currency value, and definitely, debt monetization, or let's say primary money to pay debt, can cause hyperinflation, drastically weakening a currency. And the sixth of these causes is political stability and governance. Uncertainty or conflict in a country can scare away investors, reducing confidence in the currency and lowering its value. In effect, political stability, strong institutions, and effective governance attract foreign investment, while political turmoil, corruption, or civil unrest scare investors and can cause currency depreciation. I don't think I need to explain any further for you guys to understand political instability and how it can affect currency. The next is speculation and market sentiment. Traders now, forex traders and their stuff. Traders and investors' expectations of future economic performance or political event can cause currency values to rise or fall. Even rumors or political tension can impact exchange rate, like we all know. So the next is central bank policies. Central bank influence currency value through one, interest rate changes, and also open market operations, and also foreign exchange interventions. For example, a central bank may buy or sell its own currency to influence its strength. And the ninth of the causes is commodity prices. in a simple way for resource. And the ninth of the causes is commodity prices for resource-rich nations. For countries that rely heavily on exporting commodities, for example, oil, gold, or some stuff like that, global prices of those commodities affect the currency. Example, Nigeria's Naira often weakens when global oil prices drop. The Nigerian government are seeing that as a very, very, very huge red flag. Nevertheless, they never even spend a minute of their time thinking of expanding their sources of income. The tenth of the causes is excessive money printing. Printing too much money without matching economic growth leads to inflation and reduces the currency's worth. And the 11th of the reason is balance of trade, export versus import. When a country imports more than it exports, demand for foreign currencies increases, weakening the local currency. Are you seeing this? Now, lowering the value of a currency makes a country's export cheaper, which can help reduce the trade deficits. Are we understanding this point? This point is one of our major challenges here in Nigeria. Under this, there are two factors also, a trade surplus and a trade deficit. Now, the trade surplus is more export than import. This increases the demand for a country's currency, thereby strengthening it. While a trade deficit, which means more import than export, increases supply of the local currency in the global market, thereby weakening it. And obviously here in Nigeria, we import even the toothpick we use to get some meat out of our teeth. Now, let me explain this point further because, like I told you, is one of our major challenges here in Nigeria. When a country devalues its currency, its money becomes less expensive, making its export more attractive and competitive internationally. At the same time, imported goods become costlier, leading to a drop in import demand. Government often use this strategy to fix trade imbalance by encouraging more exports than imports. Are we understanding this? Now, as export grows and imports decline, the trade deficit tends to shrink, improving the balance of payments. This increase in demand for cheaper export helps the country reduce its trade deficit. Now, while this may sound like a good deal, it also brings with it a tons of problems, especially if a government is full of morons, like the guys we have in here. Although devaluing a currency can be beneficial, it may also lead to some negative outcomes. Here are some few of them. First is raising the cost of imported goods can shield local industries. But without foreign competition, these industries might lose efficiency and thereby, if there is no high competition, if there is no strong competitors, what usually happens? I want to make this video as short as possible, so let's leave the explanation here. And second is a rise in export compared to import can boost overall demand in the economy, which may trigger inflation. And that is one of our challenge here. We export almost we don't process them here. Our farm products and a lot of stuff like that, we export. Obviously, we don't process most of them. The third point is, since devaluation makes export more affordable, producers might feel less pressure to reduce expenses, potentially driving up long-term prices of goods and services. Now, let's look back to Nigeria specifically. Actually, in order to understand this, we need to look a bit back through the history of Nigerian Naira, and through that we can compare and explain further. So here is a brief a summary history of the Nigerian Naira devaluation. Nigerian Naira has had its fair share of tumbles. I mean, it has experienced significant depreciation against major global currencies such as the US dollar, British pound, and the euro since its introduction in 1973, and that is over the past several decades. Here on the screen is a comprehensive year-by-year breakdown highlighting key periods, the government administrations, and the specific actions or events that influence Naira's value. In 1986, under General Ibrahim Babangida, the structural adjustment program led to a significant devaluation. There's no point for us to explain this structural adjustment program. We want to make the video as short as possible. But fast forward to 1999, President Obasanjo's era saw further declines. Now, in 2016, under President Buhari, wasn't any kinder as well. And by 2023, under President Tinubu, the Naira faced new challenges, which is higher than all the rest. Here's a historical overview of when some currencies began to surpass the Naira in value. You see, in 1973, that was when the Naira was first introduced, replacing the Nigerian pound at the rate of 2 Naira equals 1 pound. At that time, 1 Naira was equivalent to approximately 1.52 US dollars, making the Naira stronger than the US dollar, which is, as of today, almost, we don't even have to talk about that one. But in 1986, the introduction of the second pound tier foreign exchange market, SFEM, led to a significant devaluation, and by the end of 1986, the exchange rate had shifted to 2.02 Naira per 1 US dollars, marking the point when the US dollar surpassed the Naira in value. Now, feel free to pause this video and read the details on the screen. Now, comparing the Nigerian Naira and the pound, how the depreciation occurred over time. In 1973, with the Nigeria's introduction, 2 Naira was equal to 1 pound, meaning 1 Naira is equal to 0.5 pound. Thus, the British pound was already stronger than the Naira since inception. But, or let's say, in 1986, following the devaluation due to spam, the disparity widened, with the pound maintaining and increasing its strength relative to Naira. Naira just goes down a bit. Also, feel free to pause the video and read this in details on the screen. Comparing with Euro, in 1999 the Euro was first introduced, and by the early 2000s it was already stronger than the Naira. The average exchange rate was approximately 476.65 Naira per 1 euro in 2021. And in 2023, the euro reached a height of 993 Naira per 1 euro, reflecting the continued depreciation of Naira. While in 2015, I leave that for you to guess. Also, feel free to pause this video and read that in details on the screen. In summary, the reason behind the Naira's devaluation, we would say that the Naira's decline against the major currencies has been influenced by various factors, including first is over-reliance on oil. Nigerian dependence on oil export makes the economy vulnerable to global oil price fluctuation. So if anything should happen to global oil price, then definitely Nigeria is going to be among the ones that are going to bear the consequence, and that is not a good thing to look into. Another thing is economic policy decisions. Implementation of SAF, that is the Structural Adjustment Program, exchange rate controls, and subsidy removals have had significant impact on the Naira's value. And another thing is economic mismanagement. Corruption, inadequate infrastructure, and inconsistent policies have undermined investors' confidence. Looking at the next, global economic trends, also called global market dynamics. Global financial crisis and shift in foreign investment patterns have influenced Nigerian currency instability. And the next is inflation. Inflation is one of the popular reasons for the depreciation of Naira, which I believe every Nigerian has once come across this word and have understood it. And to make this video as short as we can, let's just skip the explanation of this. Now, the most significant shift occurred in the mid-1980s with the introduction of spam, leading to a devaluation that allowed foreign currencies to surpass the Naira in value. And why the consistent decline? That's the question running on almost all of our heads here. And that's because of over-reliance on oil, inconsistent policies. And let's be honest, a sprinkle or an overdose of corruption. Definitely, a sprinkle or an overdose of corruption. Now, with all this, do you lost hope? No. But all hope isn't lost. Diversifying the economy, strengthening the institutions, and boosting export plus tackling corruption can help the Nigerian Naira regain its strength. Definitely. The Naira might be down, but with the right moves, it can flex its muscles again. Stay informed. Stay hopeful. Now I remember. Me and my team spent an impressive amount of time and resource to create this and bring it to you. This is a new channel. The least you can do to put a smile on our face is to like this video and share it. If you did not subscribe yet or follow, please subscribe or follow. Thank you. We love you.